Did you know that just by watching the videos on this channel, you are making the world a better place? That's right. Every video you watch helps bring high-speed internet connectivity to remote communities around the world that are in need. Every view, like, comment, and share counts towards making our goal of worldwide internet connectivity a reality. So please join us in our mission to connect the world by sharing our content and becoming a subscriber today, because together we can make the world a better place. Hey everyone, the third quarter wasn't great for the markets, facing challenges and ups and downs, but here's the good news. November turned things around and the markets have been sailing higher ever since. We have a lot to cover with our indicators, so let's get to it. Hello and welcome to Investing Made Simple. I'm Joe Macek, Portfolio Manager and Investment Advisor at IA Private Wealth, providing fully licensed and trusted investment guidance for over 23 years. Thank you so much for tuning into my YouTube channel, where you'll find the most trusted financial content to help you grow your net worth. And as always, before we get too deep into the video, I'd like to go through my usual disclaimer. If you have any questions surrounding your investments on a personal level, feel free to reach out to me on a one-on-one basis, as my contact details are now provided in the description below. In this video, I'll be talking about what happened in the third quarter using 7 key points illustrated by some charts. I wanted to try to give you a clearer picture of how the economy was doing and what trends stood out in the third quarter. Each chart and point will tell a part of the story, helping you see the main events and changes that shaped the period. In the third quarter of 2023, US equities experienced a decline following a robust start earlier in the year. The S&P 500 Total Return Index dropped by 3.3% this quarter, marking a departure from 3 consecutive quarterly gains. November, though, brought a notable shift in market dynamics, largely influenced by comments from Jerome Powell. His indication that interest rates would likely remain neutral for an extended period, but leaving the door open for more hikes, spurred a turnaround in the markets, again largely moved by the Magnificent Seven. However, the Fed's comments on December 13th further took the markets higher, especially in the REITs and the interest sensitives. So it would seem the markets are moving on words delivered from the Federal Reserve, and now they are fully anticipating rate cuts into next year. The yield curve is doing something interesting as well. At first, it looked like the curve was actually steepening in October, and we were headed back towards normalization. But then, just as I thought we were trending back, we reversed course. Right now, the yield curve shows a negative 124 basis point spread. This is important because it suggests we might still be facing economic troubles and haven't fully moved past the possibility of a recession. Even though there have been some signs of economic improvement, this negative shift in the yield curve tells us that there are still challenges ahead. It's a clear warning sign that we need to be careful and keep an eye on how the economy is doing. And understanding these changes helps us make smarter decisions in these uncertain times. The S&P 500 is currently more concentrated than ever before. To give you a sense of just how concentrated it is, over the past 35 years, the usual average for the top 10 stocks in the S&P 500 was approximately 20%. Back in the dot-com bubble, the top 10 stocks made up 25%. Now it's even higher at 32%. Both times, these top stocks were mostly from the tech and internet sectors. And at the risk of saying those deadly words, this time it's different, the current situation with technology is different. But this concentration trend does raise questions about how the market might behave and what it means for investors. After the dot-com bubble, the concentration in the index sorted itself out when tech companies saw vicious declines in their share prices. Currently, the Magnificent Seven stocks, responsible for over 100% of the year-to-date 2023 returns, make up only 27.5% of the index. Unlike the tech bubble, these companies are financially robust, highly profitable, and have growth rates and margins that are double those of the broader market. Their current valuation, while expensive by most measures, align with their historical averages, supported by solid fundamentals. Additionally, the Magnificent Seven companies have unique competitive advantages, suggesting that the concentration trend in the index may persist in the current environment for some time. In my Q2 market commentary, I expressed concerns about the sustainability of the market rally, and those worries were validated as the rally lost steam and took a significant downturn. However, as mentioned before, a notable turnaround occurred swiftly when the Fed statement seemed to act as a catalyst, reigniting the market rally almost instantly, and we're seeing strong gains leading into December. Despite the recent boost in the market after Powell's comments, I still have my concerns. While his words gave the market a lift for now, the fact remains that the yield curve is still inverted and is still making me very cautious. It's a reminder that there are ongoing risks that we need to keep an eye on. And let's not forget about the Federal Reserve's balance sheet, which has been quietly undergoing a steady reduction since the beginning of the year. This gradual unwinding, while less conspicuous than the official interest rate hikes, contributes to what some refer to as shadow rate hikes. It's crucial not to dismiss the impact of this quantitative tightening, as it also has implications for the overall markets. Another important consideration is the consumer balance sheet and how it's faring on the Fed checkable deposits. Since we began tracking this measurement early last year as a means to gauge the health of the consumer, the Fed checkable deposits data reveals a concerning trend as it continues to lose momentum and trend lower. This suggests that there's less cash available in individuals' bank accounts, impacting their ability to cover inflationary expenses and engage in consumption. The decline in checkable deposits reflects a growing constraint on spending power, highlighting the pressure individuals may be facing in managing their finances. Looking at the personal savings rate from Fed data, there was a small improvement around October, but it has dropped back down to the 3.8% level. This points to a continuation of the historically low savings rates for consumers, highlighting that people might be finding it challenging to set aside money for unexpected expenses or disruptions in income. The health of the consumer is absolutely crucial because a whopping 70% of the US economy is driven by consumption. In essence, if the consumer isn't doing well, the overall economy is likely to suffer as well. Consumers fuel the economic growth through their spending on goods and services. When they are financially healthy, they're more likely to make more purchases, contributing to business revenues and supporting job creation. However, if the consumer faces financial challenges, their spending habits may contract, putting a strain on businesses and potentially leading to economic downturns. In short, a robust and financially stable consumer is the backbone of a healthy and thriving economy. Meanwhile, in Canada, there's a growing possibility that Canada could initiate rate cuts well before the United States, reflecting an apparent divergence in economic trajectories. Recent indicators suggest that Canada is experiencing a more rapid economic slowdown compared to its American counterpart. This divergence in the pace of economic deceleration may prompt Canadian policymakers to consider preemptive rate cuts, and in the US, the markets also seem to be pricing in rate cuts into mid-next year. This is widely seen as a welcome relief for all consumers in both Canada and the US. The lower interest rates bring about positive implications for various aspects of personal finance, such as reduced borrowing costs for mortgages and other loans. This shift in monetary policy is perceived as a supportive measure for consumers, potentially encouraging spending and investment. However, it's essential to remain mindful of the broader economic context and delicate balance that policymakers must navigate to ensure sustained economic stability. And here's a note on oil prices. While the current low oil prices are generally considered stimulative for an economy serving as a cost-cutting benefit for consumers and businesses, they also raise concerns. The dip in oil prices might be indicative of weakening demand, signaling potential economic challenges ahead. The oil markets often act as a barometer for global economic health, and a decline in prices can be a red flag, reflecting subdued demand and potentially sluggish economic activity. The dual nature of low oil prices providing economic stimulus while also hinting at underlying demand issues underscores the complexity of interpreting commodity markets in the broader economic context. Investors and policymakers alike are keeping a close eye on these dynamics to gauge the overall health of the economy. Okay, so where does this leave us? While the recent market rally is promising, I remain cautiously optimistic and not entirely convinced that we are out of the woods yet. The deep inversion of the curve remains a red flag, indicating potential economic challenges ahead. As we closely monitor data from the Fed, there are various headwinds evident. With bank account balances dropping, savings rates at all-time lows, interest rates staying high, and the Fed continuing the balance sheet roll-off, this does not set up for a healthy market going forward. While there are positive aspects to the current market trends, it's crucial to navigate with caution and be mindful of the broader economic indicators that may influence the trajectory moving forward. The prolonged and deep inversion of the yield curve for over 13 months without any signs of reversal raises concerns about an impending recession. Even though we adopted a defensive stance in our portfolios as early as the first quarter of last year, the intensity of the inversion has led us to officially enter a recession watch mode as of October 18th, 2022. We anticipate this cautious approach to extend for a 24-month period until October 18th, 2024, or until we observe a significant market decline, whichever comes first. For the next 12 to 18 months, my forecast largely remains unchanged from the past 6 to 8 quarters. Cautiously optimistic with an emphasis on caution. I see potential for positive developments, but recognize the need for prudence in navigating the uncertainties that persist in the economic landscape. Monitoring market trends, being mindful of potential risks, and adopting a cautious approach to investment decisions will be paramount during this period. The upcoming year 2024 being a presidential election year adds an extra layer of intrigue to the markets. Presidential election cycles often bring about heightened uncertainty and potential market volatility. If the economy is facing a recession, the dynamics of the election and its impact on market outcomes become even more complex. For younger investors with several years until retirement, the next 12 to 18 months could be an amazing period given the likelihood of frequent market downturns and sales, especially with modestly invested capital. Look forward to red days and buy on them. If you've been capitalizing on market dips in the last quarter, consider continuing this strategy, focusing on seizing buying opportunities. In a bear market, attractive deals on excellent companies may emerge. Now, despite the potential for more sell-offs and deeper dips in the future, continue to buy on red days and dips. While it might be disheartening to witness the market go down after each investment, the long-term payoff is likely to make the consistent additions to your portfolio worthwhile. For those nearing or in the early stages of retirement, the current market conditions may pose mental and emotional challenges. With a substantial amount of capital invested and very likely limited means to replenish that affected principal, preserving capital becomes a crucial priority. If you've already scaled back equity exposure in the first part of the year, it may be prudent during this recent market rally, continue this approach and reduce equities during any market upswings. Periodically assess your portfolio and, if there are any volatile or high-risk positions, consider reducing them in favor of investments with a proven track record in weathering challenging times. Well, that's it for this quarter. I'm Joe Macek for Investing Made Simple. Until next time, we'll see you soon.